Hello and welcome to the American Compass podcast. My name is Oren Cass. I am chief economist at American Compass. And as usual, we have an exciting episode for you today. This time we are talking with Ruchir Sharma, who is author of an excellent new book, What Went Wrong with Capitalism. I think one of the things that's most interesting about it that we really get into in depth is it marries a lot of the more traditional conservative concern about overregulation and economic sclerosis with the more populist critique of the ways that capitalism has really gone off the rails. And it's, something I emphasize often when we're talking about American Compass is that there are some things we think the old right was entirely right about. And when it comes to overregulation in particular, that's obviously a huge problem. And so I think this was a really good discussion that gets into the intersection of those various forces. Also, want to tell you about what else we've got going on at American Compass this week. A few really fun pieces on the Commons. Patrick Brown's Silver Linings Playbook, talking about some of the really encouraging economic data that has come out in really recent years, indicating that in some respects the economic picture for American workers is better than it has been in a while. Also, a great piece by Aaron Wren on why conservatives should care about city governance. And coming up on Thursday, we'll have a piece from me on the latest mess of an immigration debate as economists continue to find some way to explain that immigration is always wonderful for the economy, even as it is not wonderful for workers. One more item, Compass Point this week, I think is particularly interesting, which it is Michael Lynn's return to the Commons with a really fun piece. So what if tariffs are taxes? Making the argument that, in fact, consumption taxes, even if they are relatively more regressive, can be exactly the right conservative economic model. And rather than think of progressivity, regressivity of the tax code as an end unto itself, the question is whether we have an economy that works for workers. And the tax code makes up for problems, but if we have fewer problems, all the better. So definitely check that out as well. Last thing I have to plug, the Substack, of course, Understanding America, every Monday, every Friday. Readership up 30% in 3 weeks. If you're not among that crowd, you're clearly missing out. So go subscribe. And in the meantime, enjoy this episode. And joined now by Ruchir Sharma. Ruchir, thanks so much for joining us.
Thanks, Oren. I'm so looking forward to our session.
I am as well. I have to say it's only once or twice a year where, a book actually comes out that I just see popping up everywhere, and then all of a sudden everyone's asking, "Hey, did you see this? Did you read about this?" And at least in our little questioning neoliberalism corner of the world, you have scaled that wall. So congratulations. It's a fantastic book.
Well, it's gratifying to hear that from someone like you because I know that how much you're thinking about these issues. And that was exactly what I was trying to do with this book. As I say, that the first step to a cure, which I think all of us are looking for, is to get the diagnosis correct. So that's the attempt of the book.
Yeah, no, I think that's exactly right. And it's funny how people are very uncomfortable saying anything's wrong with capitalism because then you must be a Marxist or whatever. I think it's always important to emphasize, among other, even Marx had many good diagnostic analytical points. The what to do about it, of course, becomes a much different conversation. But let's start with your diagnosis. We will send everyone to read the book now, but assuming they have not already, what went wrong with capitalism?
Well, I argue in the book that capitalism did not fail, it was ruined. And what I show in the book is that if you really look at how capitalism was, uh, historically, it was very different, let's say, pre the 1920s. And after the 1920s, capitalism has become a much more sort of system of where risk has been progressively socialized over time. So I know that the likes of Bernie Sanders like to call it socialism for the rich. I have some sympathy for that argument, but I feel that what's happened to capitalism is that that risk has been socialized across the income curve, whether it's for the middle class or for the people at the bottom end of the pyramid. And so what we have today is a very distorted form of capitalism. And so the capitalism we had before the 1920s was very different. And now what we've gone the other sort of 180 degrees, which sort of I compare is analogous to almost the pain management system we have in America, where the slightest hint of any pain, we tend to administer opiates. And so the entire economy, in a way, has also become hooked to having opiate, just like America's facing an opiate crisis. I think that we are facing a sort of bailout, kind of opiate crisis for the overall economy.
And I want to dig into every element of that, but to push you further on one more piece, then what is the consequence? Because I think some people will say, "Well, what are you talking about? The U.S. has strong economic growth, at least relatively speaking, right now. Unemployment is low, inflation has come down, people's standard of living is the highest it's ever been. Why has anything gone? What makes us say anything has gone wrong with capitalism?"
Okay, so I think that's great, right? So in terms of what's gone wrong is that most people in America are not happy with the current economic. So whatever the headline economic growth is, if you just look at the surveys, as you well know, most people in America think the country is moving in the wrong direction. You have people who are even independents, about 60% of independents in surveys, who think that the entire economic system needs to be changed, if not toned down. These are very strong numbers. And many young Americans, especially young Democrats in this country, say that they would rather have socialism than capitalism. So that just tells you about what's happened, which is that no matter what the headline numbers are, for the average person, capitalism or the current economic system is not working, just given the strong pushback that you're seeing from people. That's the one apparent consequence. The second is the fact that if you look at productivity growth, which is key to economic growth, as you well know, over the last 30 to 40 years, productivity growth has been progressively declining in the country. And this is something which is happening across the Western world. And this brings us to the final point I want to make here, which is that yes, America looks better, but relative to whom? Looks better relative to, let's say, Europe or other Western countries. But as I argue in the book, that capitalism is in worse shape in Europe and UK because productivity growth in those countries has virtually fallen to zero. So I think that we need to get the metrics correct, which is that who are we comparing ourselves to? And the fact that most people in America today are not happy, where you have only 35% of Americans today who feel that they are likely to be better off than their parents, compared to, let's say, 50 years ago, where 70 to 80% of Americans felt that they were likely to be better off than their parents. We've seen that sort of a decline take place. Clearly, the current economic system is not working. And if it looks good, it's only in comparison to even more, if I can say so, decadent economic places such as Europe.
Yeah, I like the focus on productivity. I think is certainly mine as well. And well, sometimes I get asked the question, well, what's the one metric you would focus on? And I always reject that as a terrible question. But if pressed and forced to answer, I think you're exactly right, both in terms of understanding what has gone wrong, in terms of understanding what we should be aiming for, and in understanding sort of the premise of capitalism. Because of course, there are plenty of ways to generate growth that don't generate a lot of productivity growth, or that only generate productivity growth for certain groups. Um, and so I think that that's a very helpful frame. I'll keep coming back to that as we're talking. Okay, but what does that mean for productivity? Um, but let's go back to the beginning, because I was struck with your diagnosis that you start in the 1920s. And I think that's definitely different from most folks in this space who start, including myself, start in the 1970s. And I think a lot of people see the 50s and 60s as sort of, they would say that was the golden age in a sense, certainly in productivity growth terms and so forth. And it was really the changes in the 70s, and then the Reagan Thatcher revolution and so forth, liberalism post Cold War, that that we like to point our fingers at. So why start back in the 1920s? What was going on then that you think is a key part of the story?
Yeah. So I think capitalism we had until the 1920s was very much a laissez-faire form of capitalism. And we had a period really, from the late 19th century, right up into the 1920s, where it was a very raw form of capitalism, which was also accompanied by very high productivity growth. That you got very high productivity growth at that point in time, and you end up getting these very strong boom bust cycles. In fact, America spent about 40% of its time in that period in recession. but the average economic growth and the average per capita income growth was very high, because when you would get a boom, it would be a very powerful boom. That was the true productivity kind of capitalism that we had there. And the context here is very important, which is that most people today, historians, say that big policy mistakes were made in 1929, and that's what led to the Great Depression. And they are partly true. But the context here is very important, which is that, there was a forgotten depression in the 1920s, and something that I enjoyed researching for as I was doing this book. And that forgotten depression in 1920 was the American approach back then used to be that we will not touch the business cycle. The business cycle needs to take care of its on its own, let it sort of play itself out. And that approach worked well, because in the 1920s, which followed, then you got the roaring 1920s, where economic growth by the middle of that decade surged to about 8 to 9%. And then, of course, as happens, the strength taken too far becomes a weakness. So that context is important, because in 1929, why did the policymakers behave in this way, which appears so irrational today, which is to almost suggest liquidate, 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 as the famous term of that era went, that you let the cycle liquidate, and then we will come back and see as to what happens, because it usually leads to very high productivity growth. And that didn't happen. And then you ended up getting the Great Depression because of the policy mistakes that were made back then. But it's important to put that context and see that capitalism world. Once that was done, then the pendulum began to swing the other way, which is that every decade after that, as I show in the book, you started to get more and more actions where the government got more and more involved in the cycle. It first started off, obviously, with the creation of a welfare state. And then and then, of course, you got some sort of more industrial policy kind of involvement of the government back in the 1950s and 60s. But more than that, I think that what I show in the book is that every decade you had much greater government involvement in the economy. In the 1960s, as I point out, was the first time under Kennedy that the government actually cut taxes in the middle of an economic recovery to try and stimulate economic growth. 1970s was filled with all sorts of government involvement, like price controls and everything that you had. And I think that one of the big things I deal in the book is the 1980s, because a lot of people think of the 1980s as the start of some uh, neoliberal revolution under Reagan and Thatcher. And I say, yes, it's partly true that what happened under Reagan and Thatcher was the fact that you got massive deregulation of the financial markets for a while at least. And then you also ended up getting tax cuts, but those tax cuts were all funded by increasing deficit. The culture of running deficits also began in the 1980s, because they did not want to touch spending. So the political establishment there tolerated tax cuts, but not spending cuts. So you got tax cuts, you got in terms of also a big push towards globalization, which took place in that era. But what you did not get in the neoliberal era, so to speak, were any spending cuts. Spending as a share of GDP remained on an upward trajectory, with some slowdown during Reagan. And then, of course, when the economy boomed in the late 90s, you got some. But generally, spending as a share of GDP for the last 100 years, so the first 200 years of American history, spending as a share of government spending as a share of GDP was stable at about 3% or so. Then, following the Great Depression, it begins to increase. And every decade, you see a rising trend virtually, where it goes from 3% of GDP to nearly 40% of GDP today. The total amount of government spending at the federal and state levels has gone up to 40%. And that ascent continued through the 1980s as well. But there are a couple of very important things which happened in the 1980s, which showed that this culture of government intervention was going on even during this Reagan Thatcher era. One of them was the culture of bailout. As I argue in the book, that until the 1970s, really, there was no culture of bailing out private sector companies in America. The American form of capitalism was that, listen, the government, yes, will now manage the business cycle, but we're not going to bail out companies. In 1984, we get a very significant bailout of Continental Illinois, the first big financial bailout which happened. And that really sets the tone then for an increased number of bailouts after that, the savings and loans bailouts, the NTCM, then obviously 2008, the pandemic bailout, and then as I argue in the book, most egregiously, the savings and loans bailout, which happened last year, which was almost a preventive bailout because now every time like America has any small problem, the paymongers tell us we'll have a Great Depression, so we have to bail the company down. And the second thing which happened very significant in the 1980s was in 1987 when the stock market had a crash. And for the first time, the Fed cut interest rates to explicitly help the stock market, which came to be known as the green pan put. And that really led to this culture where the financial markets sort of saw risk becoming more and more one way. There on the upside, the gains were were unlimited. On the downside, the government or the Fed would be there to backstop the losses. And that asymmetry, I think, was a very important part in the increased financialization of the entire economy in America. So these very two significant developments took place in the 1980s, I think, which really argue against this narrative that we were in this era of reduced government. And most people think of the neoliberal era as government in decline and less intervention. And I say in the book, that's a myth. Yes, the neoliberal era did involve globalization, did involve decline in the power of union, did involve some financial sector deregulation, and did involve countries like China, India, and all adopting much more of a capitalist, sort of system. But it did not involve a reduced role for government in society.
I think that's a really important point. It's almost sort of the worst of both worlds because you describe, you'd mentioned the idea of sort of the socialization of risk. And then the flip side of it is sort of the privatization of profit and gains. And in a sense, what you're describing is both sides of the coin simultaneously. You both have government playing an ever bigger role on the downside, whether that's for individuals, for companies, for financial markets, for the economy as a whole, even as it pursues this set of policies that is intended to ensure that the same interests gaining the most protection also have the most upside in a sense. Um, but as I promised I do, let me ask the question. So what does any of that have to do with productivity?
Exactly. So, one of my favorite chapters in the book is labeled the productivity paradox, which is the fact that why have we seen a decline in productivity over the last 30 to 40 years, despite the fact that we've had so much technological innovation? Now, some of the economists come back and say that, yeah, the productivity measures are dated, they're not capturing the productivity surge in the economy. I'm like, yeah, but if that was happening, then in the late 1990s, we did see a brief surge in productivity when the internet revolution really sort of got going. So it's not as if the data doesn't capture it, and there's always some technological change in history which is going on. The best explanation I have for the productivity decline that's happened over the last 30 to 40 years is that the uh, creative, destructive fiber of the economy has been undermined by this level of government intervention. And the data that I present in the book, I think, supports that. What is that data? One of the key things that I mentioned in the book is the zombification of capitalism, which is the fact that, this term really was popularized in the economic landscape in the 1990s in Japan. That's when the term zombies became popular, and it referred to these very unprofitable Japanese companies that were kept alive because of the easy money thrown by the Japanese government and by the central bank there running a zero interest rate type policy. So a lot of unprofitable firms were able to survive, and that was seen to dampen down productivity. Back then, the American media, including the likes of the New York Times and stuff, would write about the fact, would almost mock the fact that you had these zombie firms in Japan, and the sort of tone of those pieces would be, "This is America, we don't do this," and sort of rightly so because the number of zombie firms in America then find as companies which for 3 years in a row haven't made enough profit to cover their interest expense. So they have to keep going back to the market to borrow, and they can only keep alive as long as they have access to zero interest rates and very easy finance or so. Those companies in America were just about 2% of the total number of listed companies in America. Today, by some measures, such as the BIS and other financial institutions, 20% of all companies listed in America can be classified as zombie firms. That's a huge surge that has taken place. Now, when you have so much deadwood in the economy, that is bound to reduce the rate of productivity growth in the economy. And the way it plays itself out is if you look at the number of startups in America, that right up until the pandemic had also been in declining trend. So you have this sort of pincer movement where you have these zombie firms being kept alive because of the government's policies. And a lot of the firms in the middle and new firms getting squeezed out. And at the top, of course, you have oligopolies that also thrive in a culture which is so supported by the government. And that's a pretty topic I think that we should discuss. But so the productivity decline for me can be uh, associated based on all the data that I have to this zombification of capitalism in a big way that has happened, which has undermined the creative, destructive fiber of the economy over the last 3 to 4 decades.
The breakdown of zombies like that is very interesting and reminds me in particular of a project we did at American Compass a couple of years ago, which was a little bit different. We were looking at what share of companies were actually investing, making capital investments faster than they were depreciating their existing capital base, and split the market into what we called sustainers, which were companies actually investing to maintain or grow their capital base, and eroders, which were companies that they were profitable, but they were returning capital back to financial markets so quickly they were actually allowing their own capital base to erode. And we found exactly the same trend. If you went back to the 70s or 80s, there's a minuscule share that were these eroders. And as of the mid 2000s, you actually start hitting points where the majority of US market capitalization were eroders. And I think that speaks more to the top of the market, those oligopolies where the task is no longer to invest necessarily at all, so much as to just extract as much profit from the existing operations. Um, I guess the question I would ask is, well, that that diagnosis, both the ones I described on the eroder side, yours on the zombie side, explains what's going poorly with a lot of established firms. It doesn't explain, I think, the decline in startups. In other words, you would think this is therefore a market especially ripe for disruption, new entrants, and people would be banging down the doors to do that. What's your diagnosis for why that piece of it has gone away and we've seen a decline there?
But I think that, yeah, one of the biggest problems that I think that America faces today and many Western democracies face today is the number of regulations that are put into place and how expensive it has become for a new firm to get going. Like in terms of, I know this from personal experience that when I tried to set up my own fund after having worked at a large firm for a long period of time, the cost of setting up a new investment firm today, just as an example, is roughly 10 times higher than it was 20 years ago. Why? Because of the amount of regulatory compliance and other attestations that we have to make. So the break even point now for a new firm to survive in general is a lot higher because of the regulatory stuff that you have to deal with. You know that this is true of large banks and other places. They have the resources to deal with, they have the money to deal with. But for small firms, it's very hard. And, like as I show in the book, that so many small banks and stuff are just not able to deal with this. And so that's a major reason as to why they become unprofitable and can't survive. So I think that it's the amount of regulation, as I show in the book, that the number of new regulations that America introduces every year has really skyrocketed in the last 20 years. On average, like they're introducing about 3,000 new regulations a year. And guess how many have been withdrawn over the last 20 years? 20 in total, right? So it's this asymmetry of regulation, which is that you just mount and mount the number of regulations which are introduced out there. And as I show in the book, that under the Biden administration, they've just gone on steroids in terms of the kind of regulatory denseness that's out there. And so, therefore, a lot of small and mid-sized businesses, I think, are suffering, and that makes the entry rate and the and the exit rate both higher for companies across America.
The political valence of the critique is really interesting then, because to your point, in some respects, that some of this sounds like Bernie Sanders. On the other hand, some of this sounds like Charles Koch, and um, it, that's fine. I we at American Compass likewise try to confuse people in that respect as much as possible. But it does then raise the question in my mind of, okay, when the rubber meets the road, what is what is the direction to go? Is the answer that you think starts to address these things rapid deregulation, rapid slashing of spending in the safety net? Um, or does that itself then produce yet another set of problems?
Right. Yeah. So I think that in terms of there are some stuff which I think is practical, and the other stuff I hate to say, Lauren, is that looking at the experience of other countries, which is that until and unless you have an outright crisis, the crisis we are talking about here is much more insidious, right? With a decline in productivity growth, and so people sort of find that a bit intangible. But the time when countries begin to truly reform themselves is when they have an outright crisis. And that was the experience of, let's say, something like Sweden, which a lot of the liberals and the Democrats love to talk about, that Swedish model of democratic socialism or whatever you want to call it. And there, if you look at it, like in the book, I spend a lot of time in it, which is that in Sweden too, you had a financial crisis, a fiscal crisis in the early 1990s that forced Sweden to start course correcting. And in fact, now Sweden, in most years since then, has either been running a budget surplus or close to a budget balance, right? So, in terms of, and they've reined in their government spending. And similarly, there have been other countries like Greece and stuff, which were forced to dial back when government spending got out of control and the deficit got out of control, and the markets were no longer willing to fund it. Now, this is America. This is an economic superpower. They have a much greater ability to spend, much greater ability to borrow. There are great things still happening in America where people still want to come and, has a lot more latitude. So I don't see scope or the political consensus building anytime soon for cutting back on spending. But what is realistic? What can be done, I think, by any right thinking administration? One, I think, is to do with regulation. As I've just penned an op-ed for the Financial Times on this, which is the fact that I asked question provocatively, that is Trump the king of deregulation? And you find that in his term from 2016 to 2020, the records are a bit mixed on that, because the amount of, because he did introduce a lot of new regulations as well while cutting back on some. But at the end, the number of new regulations introduced, was still close to, about 3,000 a year, which was same pace as Obama. So something which I think any new administration needs to think about is really need to cut back on the pace of regulation and to sort of see how to withdraw some more regulation. I think that for me, for the want of a better term, the lower hanging fruit in terms of what can be done in terms of that. The second, I think, is to draw a line out bailout, because I think that bailouts, is a very sort of asymmetric thing. I think it's the modern form of trickle down economics. This logic that people give, and I'm surprised by the number of people on the left and liberals who sort of back this stuff. And when they come back and have arguments with me and say that, oh, so what do you rather do? Let all these big firms fail and we'd have mass employment and we could have a Great Depression again and stuff. I say, yeah, but this is the modern form of trickle down economics. We want to protect all these large firms and other firms from failing because of the fact that you spread this fear that if they fail, we'll have the Great Depression. But then just look at how the average voter feels, that if these firms are getting bailed out, and if these firms are getting like all these protections, why am I not getting even more? Why am I struggling to make my sort of daily balance meet? So I think that that's the second part. And the third aspect, I think, which is the framework of the Fed. There's they're so focused on the narrow framework of consumer price inflation and this very asymmetric reaction of the Fed that on the upside, like all the gains are fine. On the downside, they're here to protect you, but without realizing that their easy money policy have also fueled a big increase in property price. And so many average Americans feel that property is out of reach for them because all the asset owners tend to be the rich people, like who own properties, who own stocks and benefit from all this easy money policy. But for the average person who wants to buy property, it's become very expensive. And so I think that the Fed needs to, in its framework, take into account property price inflation is a serious impediment for many people. I'd say that these are some of the things I think can be done. I'm not a big believer in offering fixes because I feel that we can spend all our time thinking about fixes and it's very difficult to form a consensus. And in my global experience, I've seen that countries only reform when they face an outright crisis. But but at least I'm glad that people like you and other people are bringing the conversation that what should capitalism look like? It can't be returning back to laissez-faire capitalism of the 1920s. It can't be, just saying that Reagan was the great icon and so we need to go back to that. We need to think about what the state needs to do in the 21st century, what role it needs to play. And also, as I said, that the realize in terms of what's pragmatic given the political fabric of this country.
Is there areas where, and I don't know if you'd even call it regulation, but areas where you see government should be doing more? So what comes to mind is we talk a little bit about globalization and, in the trade context, you will hear the same folks who generally want to deregulate, cut red tape, et cetera. In their minds, that obviously also means get rid of tariffs, which are just yet another form of interference in the market. Or certainly you hear the same thing on sort of immigration flows. You mentioned financial markets, where on one hand, it is now a lot harder to start a fund. On the other hand, there are all sorts of ways in which things seem to have spun crazily out of control. And so do you have either particular examples or just sort of a taxonomy of where are the places we need to cut red tape, but also where are the places we need more or different rules than what we have today?
I'm broadly in favor of more antitrust thing because I do feel the fact that these big oligopolies have gotten far too big and they're in a position now where they are generating so much cash flow and such incredible, insane amount of profitability that it become for me exhibit A of what went wrong with capitalism. Because what is capitalism at its core? I think we have to go back to its basic definition. Capitalism needs to be pro competition. Capitalism needs to be pro churn. Instead, what I feel what's happened to capitalism today in its current distorted form is that it's become pro big business and it's become pro establishment and pro entrenched. So I think that in terms of these very big firms, with these oligopolies, they justify it by saying that, it's network effects and it's the platform effects and, it's the hallmark of globalization that, that everything just flows to these few companies. And I think that's a wrong argument. I bust that myth in the book, saying that it's the government effect rather than the network effect, which is what's creating these oligopolies. So I think we've gotten to a stage now where they've become very big and their profits are such where they're able to gobble up whoever is in sight. And as that line goes, that you know good companies steal good companies copy, but great companies steal. And I think that you find that a lot of that is going on with the uh, large firms as well. So something I think to give greater teeth to antitrust to possibly even not allow them to acquire small firms anymore from this level is something I mean, it needs to be accompanied by deregulation as well, because otherwise what's going to happen is whack-a-mole. You will, let's say, take care of these companies today in terms, let's say like you break them up hypothetically, or you do more antitrust. But then, unless you clear the ground for more new companies to rise and have a more favorable regulatory environment for startups to thrive and to be able to survive, then you'll have new oligopolies which will just come up very soon. So you'll end up playing whack-a-mole. It needs to be both stricter antitrust, more teeth there as per legal provisions, rather than the idea that or just leave them alone because, they're a symbol of America and look at all that they're doing. No, not really true. There are other great companies too, which can do well if they're allowed to thrive. And capitalism is about no companies being able to earn supernormal profits for too long. Uh, that is a very fundamental tenet of capitalism.
And what about on the financial market side, where obviously if you're looking for a fast growing sector of the economy, you've of course got the financial sector, and yet real investment in the creation of new productive assets, companies, et cetera, seems to be in long run decline, with it being more profitable to speculate through a hedge fund, use private equity and leverage to buy this and break it up, and so on and so forth. To in some respects, what you're describing would make real investment more attractive. And so there might be a sort of a carrot element there. In your mind, is there a stick element needed also to get financial markets to stop doing their unproductive stuff, or is it you just want to give them something better to do?
No, I mean, as I said, it's the bailout culture. Like, when you had the savings and loan bailout of last year and stuff like that, the whole idea is that, like no company or no financial firm is too small to fail now. It's gone from too big to fail to now even a mid-sized bank of rich depositors needs to be bailed out. I think that that is something which we need to draw the line on with that, like in terms of that, we can't carry on with this bailout culture. I think that the other point also is the fact that the Fed needs to pay much more attention to the, I mean, like to the asymmetry that they just can't, that they just can't sort of say that we're going to rescue markets only when they go down. And on the outside, you don't know how to spot a bubble. So you're going to err on the side of just cleaning up the mess on the downside. I think that asymmetry needs to go and to, which will stop this sort of socialization of risk out there where a lot of people are doing that. And then, of course, the tax treatment. I mean, like whether it's the private equity getting much more favorable tax treatment, or in general, the concept where labor is taxed much more harshly than capital is, and you need a better equilibrium on that. I think that these are all things which should be on the table to fix capitalism.
All right, so I want to wrap up by pushing you on one point. Might be a point of disagreement, maybe not, which is that when I think about what you're describing sort of as a vision, part of it is what's practical, but also what you think we should sort of be striving for. It is a much closer to laissez-faire, deregulated, boom and bust model of the economy. And I think it was fascinating concrete example you gave of, look, if you keep protecting these oligopolies so that people don't all lose their jobs, that is sort of a form of trickle down economics that obviously leaves people very frustrated. That's right. And thinking that trickle down is fascinating. The flip side, of course, is that letting all of the companies fail and everybody lose their jobs would leave people very frustrated as well. And one of the things that we've been doing a lot of work on at American Compass, and getting back to this question we started with of, why are people unhappy even if so many of the top line indicators look good, is that it seems like to a significant extent our economic measures don't reflect all that well the things that people care about most. And so, when you're thinking about how they define the American dream, it isn't for the most part, have more, be better off in financial terms than your parents were, or go as far as your talents can take you. It's things like earn enough to support a family and, be able to get married and have kids. People have very strong attachments to place and wanting to be able to grow up and raise their kids where they grew up and have their kids do that too. And maybe my favorite statistic is Pew Research asks this question, which is more important to financial stability or upward mobility? And financial stability wins by more than 10 to 1, which is, just as a contrast with the kind of rhetorical description of America, I think is incredibly striking. And so I guess all of that is preamble to the question: is what people feel like is missing from capitalism a lack of, you know, bare knuckled, unconstrained competition and creative destruction and dynamism? Or would an economy that went further in that direction leave people even less happy than they are right now?
Right. I mean, I don't know how it could make people less happy, but I think that the whole point is that I don't think that there's any going back to the 1920s laissez-faire capitalism. All I'm trying to, you know, sort of show in the book is the history of capitalism. Firstly, it's a revisionist history of capitalism in terms of the fact, but to show how progressively, if we let this go unchecked, the role of government is going to just keep expanding and expanding over time. And the fleet of habits, not just government spending. It's the bailout culture. We didn't do bailouts, as I said, until the 1980s. There was no culture of bailing out companies. And that was supposed to be the start of the so-called neoliberal era. Similarly, like on regulation, we keep going down this path. We're just going to get more and more regulation, as we've seen with the Biden administration. And similarly, like for the role of the Fed. So what I'm trying to and the micromanagement of the business cycle. What I'm trying to sort of show here is that if we keep going down this path, where are we going to land up? And we haven't even spoken about the debt and deficit, because a lot of people glaze over and say, "Oh, this is about crime." And
Not
people
our
have
listeners. Our listeners like nothing better, so have at it.
yeah. So I mean, like here's where we are, which is that typically America ran a deficit, let's say, which was in line with other countries. Today, now we are running a deficit of 6% of GDP, which is like the highest deficit that we have run in the middle of an economic recovery out here. And here's the sensitivity analysis. If we do end up getting even a mild recession, the deficit will blow up to 9 to 10% of GDP. And can you imagine the funding pressures then? And then we will be forced to cut back well spending. You'll have no choice, where interest expenses are rising at pace where they're, sort of now going to be like higher than our defense spending, and then they're going to be higher than our welfare spending. What choice will you be left with but forced to do that? So we are going down that path. And if we just say that, listen, we can't tolerate any pain and we just have to go down the path, yeah, then we're going to be at a much worse place, 3, 5 years from now, in a much unhappier place where you have no choice but to cut back. So that's the path I'm trying to show here, which is about returning the balance a bit. And as I said, I think there is a role for government at every level. I'm not arguing that we should go back to some sort of, 3% of GDP type involvement of the government like America used to be for 200 years before the 1920s. I show examples in the book, like places such as Switzerland, which is the richest country in the world. It ranks among the happiest countries in the world, where government spending as a share of GDP is far less than any of its European peers and even America. The lighter touch regulation, and you have a lot of small and mid-sized businesses which flourish in every canton. Similarly, I show examples such as Taiwan, where government spending as a share of GDP nearly half that of America, and yet it was lauded for being one of the most effective states in dealing with the pandemic back in the 2020, 21 type stuff, but very tech savvy, very efficient, that you don't have to just throw money to get better outcomes. But if you have to think about how do you design a state for the 21st century, or are we going to, want the government to do everything? We want the government to do industrial policy, which used to be a 19 or 50, 1950s and 60s construct. We want the government to spend on green energy. We want the government to spend on defense. We want the government to spend on welfare. I mean, if that's going to be the issue, then in terms of the fact that the private sector is going to be sort of much less dynamic and be squeezed out. And as I said, that the average American today is feeling inequality of opportunity. I think that's really the key of fundamental construct of capitalism. It's gone back to that they're feeling that. And there are so many towns, as I show in the book in America, where which are dominated by just one employer, one big company, which dominates that town. And that like average worker has to go and negotiate with that one big behemoth. It's a huge level of frustration which builds up because of that. Like we know in America itself, there are different experiments going on. There are different states which are more business friendly, less regulatory uh, hegemons, and those states are doing better as well. So you can see the results even play out within America. But generally, I show here from Switzerland to Taiwan that there are successful models out there where you get balance correct, and you can get like richer and happier outcome.
Well, it is a fantastic book. Ruchir Sharma is the author of What Went Wrong with Capitalism. Pick it up and read it. Ruchir, thank you so much for joining us.
Really enjoyed that conversation, Oren. Thank you.
And we will be back again soon with another episode of the American Compass Podcast.